Hello, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of Crisis in Appraisal-Land. You're among more than 650 professionals who've registered for this event, so thank you all for joining us. I'm John Henschel, CRE, Global Chair of the Councils of Real Estate and President of Henschel Real Estate Services in Abingdon, Maryland. The Counselors of Real Estate is a distinguished solutions-focused consortium of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation, a badge of distinction, and a commitment to excellence. Let's recognize the exclusive sponsor for this event today, Equus Capital Partners. Thank you very much for your partnership. Before we begin, I'd like to offer you a free digital subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the United States. Please visit cre.org/REI to get your free subscription. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcome, and we'll answer as many questions as time allows. I'd like to introduce today's moderator, Geoffrey Dohrman, CRE, founder, chairman, and CEO of Institutional Real Estate Incorporated, a San Ramon, California-based publishing and consulting company providing information and data to the institutional real estate, infrastructure, and private wealth advisory investment communities. Geoffrey was invited to membership in the Counselors in 2000. Welcome, Geoffrey.
Great to be here. Thank you. And everybody tuning in, welcome to our webinar on the crisis in valuation land. To be clear, the crisis we're talking about is a crisis of confidence. U.S. investors have been raising lots of issues lately about the credibility and reliability of the appraisal process here in the United States. And there seems to be a disconnect between how U.S. investors feel about the appraisals they've been receiving and how investors elsewhere around the globe seem to be feeling about their appraisals. Elsewhere, they seem to be more confident that the appraisals they're receiving are properly marketing their property values to market. And to be clear again, this isn't going to be about bashing the appraisal community. We're not trying to place blame. What we're going to be trying to do is to identify why investors feel so differently here than elsewhere around the globe, and perhaps compare and contrast the differences in appraisal practices between regions, and then talk about maybe some remedies. So our experts today include Preston Sargent, who's representing the investor sector and their investment managers, Ben Elder, representing the Royal Institute of Chartered Surveyors, the main appraisal organization out of the UK, Paula Thoreen, CRE, representing the interests of the appraisal community here in the US, and Jim Costello, representing the research and data business. So what I'm going to ask each of you to do is just introduce yourselves briefly, talking a little bit about your qualifications to speak on the topic. And while you do, if Jim, you could put up your slide so that people can see visually what I'm talking about in terms of disconnects.
There we are.
So Preston, why don't you go first?
Sure, Jeff. Thank you. I'm happy to. Just a little historical perspective. I started in this business in 1983 in the Chicago office of LaSalle Partners, and one of the first things I did was hire Leanne Lockman at RERC to help with a project. And I don't know if that qualifies me for speaking on this panel, but probably roll the tape forward a little bit. And between 2000 and 2011, I ran the asset management group and was a portfolio manager for the multi-employer property trust at Kennedy Associates. We valued every asset every quarter. It was an $8 billion open-end core diversified fund. And I believe we were the first ones to hire Altus to do our appraisal reviews. So that was my first big exposure to quarterly appraisals. And then here at Bailard, I've been here a little more than 10 years, and we also have an open-end diversified core equity fund, and we use Altus and value every asset in our portfolio every quarter. So I think I have a fair bit of exposure over the last 25 years to the appraisal community, but hopefully can have some insights.
Okay, and Ben, if you could talk a little bit about your background. And
Yeah, sure. Thanks very much and great to be with you this evening, or this evening in the UK. Yeah, I'm Ben Elder. I'm the Global Head of Valuation for the RICS. My background, I can even beat 83. I go back to 76, so even further. But I've had sort of four main careers, one as a valuer, and secondly and thirdly into the academic world, working at universities, and more latterly as the head of valuation at the RICS. I've had the privilege of chairing the Tangible Assets Board for the International Valuation Standards Council for 6 years, and now I chair their advisory forum. I've also chaired Commission 9 at FIG, the International Federation of Surveyors, which is again the valuation stream for that organisation. So I've been really lucky to be exposed to global issues. My day job is to make sure that the RICS's Red Book remains relevant, their international global standards, to make sure they stay relevant. And if I was really proud about something, the Red Book has been through the financial crisis, Brexit, and COVID, and we haven't had to issue any emergency amendments to that document because it's a principle-based process. But I'll be quiet now and let the rest of the team introduce themselves.
okay, great. Thank you, Ben. Paula?
Hi, I'm Paula Thoreen. I'm an MAI and a fellow counselor. I lead the institutional evaluation practice at Cushman and Wakefield here in the U.S., and I'm a recent past chair of the NACREIF Valuation Committee. NACREIF's Valuation Committee is one of the largest working committees at NACREIF. Also, I had my own boutique appraisal firm for about 25 years before joining the national firms. So I'm here to share some insight on some of the challenges that appraisers are facing in the recent downturn, the appraisal process from an institutional perspective, and maybe some suggestions on how we can improve the process going forward.
Great,
Okay.
thank you,
Glad
Paula.
to be here.
And Jim, if you could introduce yourself and then talk to your chart. Help us explain it. We already have a question in from Maria Alvarez. She says, how do these numbers correlate to credibility? So you can address that perhaps when you introduce it.
Okay, well, thank you. Jim Costello here. I'm with MSCI. I started in this in 1994. I loaded up my truck and drove from Chicago to Boston to work with Ray Torto and Bill Wheaton at their Torto Wheaton research shop, and just really started digging into data and looking at numbers and telling stories about commercial real estate performance. And I love appraisers. I really do, because they'd give us data. And so anything I could do to help with new tools and help them make better decisions around stuff, I love doing. Now, Bill, who I used to work with, he has a history with appraisers. Maybe it was more contentious with everybody. But I think you know, the notion is trying to get the same spot of like giving everybody the right tools to be able to come up with better estimates of value. And really, that's what this chart was all about. It's actually my colleague Will on our team in London put this together. We do an annual study where we look at all the indexes we produce worldwide, and we look at anything that sells out of the index, the price level that it sells at, and then what it had appraised at the previous quarter. On the downside for 2023, North America was worse than the rest of the world. You know, look at the UK. I mean, Ben and the Rick stuff, my word. It's like, you know, almost the same. There's some other institutional stuff in terms of structure of the capital markets that are different there versus the US. And my colleague, I have a young colleague working with me, young economist named Willem. He's been doing some studies in the Netherlands there. There's a long history that he thinks shows that appraisals lead transactions there. But again, there's structural differences in each of these worlds, in each of these countries, rather, in terms of how appraisals are conducted and what information is allowed to be brought in, and different liquidity in each of these markets. So there's different information availability in each. The United States is more liquid than any place else, but it's more backward looking, and which sometimes is not bad, but it did, you know, in this down cycle, we did miss a little bit more than others. And so maybe there's some room for improvement with looking at best practices worldwide and seeing if we can bring it over here.
Okay.
So I'll stop sharing.
That's great, Jim. Thank you for doing that. Ben, if you could just give us maybe a little bit of, in a brief way, if you can, how you explain some of the differences in appraisal practices around the globe, particularly the difference between what's practiced in the UK and Europe and what's practiced here in the United States.
Sure. Yeah, we haven't got 3 or 4 weeks, have we? So it's a real snapshot that the process of carrying out evaluation is that the value is there to interpret the market. They don't make the market. Pretty simple to say that. But actually, when you look at the valuation process, in many parts of the world, they're looking for the evidence to support their valuation. But it's really important to recognize that actually no transactions is actually evidence. And within the RICS comparable evidence guidance note that we issue, it clearly states the processes where you're operating in markets which are very thin. I'll get shot by the valuers now for saying actually valuation when the markets are good is fairly straightforward, there's plenty of evidence, but when it gets tough, and that's when people need valuers more than ever to start to interpret those markets. The issue about looking forward or back and whether you're using data which looks backwards is a really interesting one. I absolutely believe that when we're interpreting the market, the data that we're using is from people who are looking forward. They're not looking backwards. You don't buy something today on what it tasted like last week. You want to taste it going forward. So that process of collecting the data, understanding that data, and then applying it to the circumstances that the valuers experiences is really critical. I think there are also some cultural issues in different parts of the world about being able to or wanting to move with the market. And again, we perhaps touch on that later on, that the markets are changing, and particularly in the real estate market, as real estate becomes more operational, we need to look at the different income flows and be really absolutely clear about which bit of an asset we are valuing and what rates, etc., we're applying to those issues. And that's becoming more and more complex as we move into financial instruments. And again, the International Valuation Standards Council have moved into that financial instruments world to try to harmonize some of the language which is used across valuing different assets. But again, I'll be quiet there and let the rest of the team jump in if they want to add something to that.
Okay, well, we have a question come up asking, will the presentation be shared with these participants? I'll let John answer that in his closing comments. Okay, my understanding is that it will be. Preston, you're a consumer evaluation process.
Yeah.
And I think you'd agree that credibility has been somewhat lost, particularly in the open-end fund sector. Why do you think that is?
Well, I think it's because there's some flexibility, and not everybody uses the exact same process within the NFI Odyssey world. There are 25 funds, and there are lots of different approaches, and I think every one of them has merits. And there's some in our universe that took big hits early because they had a fairly negative view of the downturn coming, and that was in 22 and 23. And then there were, in 23 mostly, maybe late 22. And then there were some that have taken their hits a little more slowly because of the uncertainty, because of the lack of transactions, because of the lack of capital, and they didn't feel it was appropriate to take big hits early. So you have, those are the two extremes, and then most people are in between. And at the same time, you have sort of historic levels of redemption queues out of the NFI Odyssey funds. And you've got investors that for whatever reason, maybe it's for rebalancing, maybe it's because they need some liquidity to pay their to pay their beneficiaries or whatever. They want some liquidity, and virtually everyone in the NFI Odyssey universe closed the window. Some closed it completely and said, you're not going to get any liquidity until we tell you. And others provided some liquidity throughout the process. So unfortunately, those combination of things, I think, have created some anxiety and maybe a little bit of anger among the investor community and a little bit amongst the consultant community.
Okay, and Paula, when you're looking at this, first of all, as a person who's active running a valuation practice right now, are you starting to see a change? Are you starting to see assets that are transacting above valuation, or are we still lagging?
I
And
still think
that's part one. Part two of the question is, how do you explain the differences? Why do you think there's such a difference between the way people have confidence in the appraisal process here in the United States versus elsewhere?
okay. I think that first of all, there still is a little bit of a lag. I am beginning to see prices coming up more so than values still going down. And I think we are finding some, stability. I think we're getting really close. But with respect to the whole appraisal process, kind of building off what Preston said, there is noise in the appraisal process, and I think that's for a variety of reasons. I think first of all, there's many voices that are involved in the process. We've got asset managers, investment managers. You've got the AMCs, which I don't believe the UK has. The AMCs are doing quarterly valuations and then handing off to external appraisers for the annual valuations. If the AMCs are not really staying on top of where those assumption changes should be, like did market rent decline between quarters, what are yields? If you don't make those changes between quarters, when you hand off to the third-party appraiser, there's going to be a change in value because that third-party appraiser is going to recognize these changes that need to be made. And also, Preston, I think, hit the nail on the head. In the very early on, late 22, early 23, there were differences among the funds into how they wanted to manage their write-downs. Some jumped in and said, hey, it's the math, cost of capital is higher, we need to be writing down, and they did so early on. And then others tried a more, I guess, cautious approach in trying to manage their write-downs. And also, going back to the quarterly handoff between, the internal appraisers at AMCs and external, those quarterly appraisals could also be done internally if an investment manager has their own appraisal department. But a lot of those internal quarterly appraisals are not necessarily USPAP compliant. It may be just simply they're not looking at transactions at all. They're not looking at what brokers and market participants are saying. They're merely just taking the Argus from last quarter, making some tweaks, and rolling it to the next quarter. So that I think that's different. I think some clients, investment managers, are empowered to do the right thing and to call it like they see it. I think others are not in their government oversight and structure. I think it's different between companies. Some have to report to OCC, some SEC, and I think there are differences there. I think from the appraisal review process that appraisers are now faced with, there are a lot of multiple back-end reviews. And sometimes those reviews have very differing opinions between the investment managers and the AMCs. I mean, some will say no, market rent should be higher, and the others will say no, market rent needs to be lower. And I think the appraisers get caught in that crossfire. And I think it's difficult, but I think we need to remember as appraisers, there's a little bit of wiggle room, but at the end of the day, you need to draw the line in the sand when you feel like value, this is the value, and you need to hold that position. Sometimes it's okay to agree to disagree. And in this downturn, that does happen. I think speaking to the lagging and looking back, which appraisers always fall in that trap, I think we try to be really careful about not basing it on indexes that are strictly appraisal based. And maybe we should be looking at, maybe we should be looking at the Odyssey transaction database more, and the index for that. And also the NCREIF daily price returns, those get released monthly. And I think that's a better indication of what's happening today, and maybe looking forward instead of us really looking, so far back. And then I think to, speak to what Ben talked about, falling in the trap of only looking at transactions. I think appraisers need to remind themselves to be more focused and triangulate the data. There's a lot of data out there, and it's not just sales. We can't really rely on sales when we don't have very many. And I think looking at even failed transactions is very insightful. I think the public market sent us some early signals. We look at corporate bonds. We should look at normalized or historical spreads. And the risk in the market. So there's a lot of data out there to triangulate with, and I think that we just need to be mindful of that, particularly when the markets are moving. So
Okay, and there's
Can I jump in there?
Yes.
Geoffrey, because that's a great answer, Paula, from that side. We had an independent review of investment valuation in the UK a couple of years ago, and there were a couple of things which jumped out of that independent review. One is a rotation. We've introduced a rotation for valuers for funds into the UK, so that there wasn't any evidence that there was anything wrong with the longevity, but it does increase that trust and getting a new set of eyes onto a valuation process. And the second one was that there was a perception that the client was able to put pressure on the valuer, particularly if the remuneration of the client was directly attached to the result of the valuation. Particularly when you're measuring against some of the indices. And that was again perceived to be a very poor governance structure. So again, RICS have worked really hard to introduce a bit of separation in that space. We can't control the clients, but we can say to the valuer, you need to check whether the person who's giving you the instructions actually has a financial return directly attributed to the valuation results. And we found that started to improve the governance of the funds, as well as the behavior of some of the valuation firms.
Great.
So
Thanks.
some really, really interesting sort of things that tie alongside, Paula, what you were saying.
Yeah,
Good.
Ben, just to follow up on that, our counterpart in the UK, I think they've mentioned that their term of contract is like 10 years, not in the US, it's more like 3 years. So there is a big difference between the two countries.
Yeah. Absolutely, and again, we picked up some evidence from the US, even when there were annual contracts, which then again put a different pressure on the valuer if they need to rebid for that contract every 12 months. So we've come down to a rotation process of 5 years for the individual valuer, but 10 years for the firm. So that there's not dissimilar to the audit profession.
There's a point of clarification that John Ellis raised. He said relative to Jim's chart, so this would be directed to you, Jim, with the USA being at a minus 6.8%, does this mean that appraisals were 6.8% below sale prices? Or were sale prices below 6.8% below appraised value?
Yeah, sorry about that. We looked at everything that's sold out of the index and what it appraised for the previous quarter. And the sale prices were 6.8% lower on average than what the previous appraisals were. So there was the transaction market was moving faster. And the challenge with that is that, if the transaction market's moving faster, how do you capture that? How do you know that? I mean, all the issues that Paul was talking about, looking at other indicators, I could talk about that, in the theoretical context of, look at the correlations of different asset classes, what are the signals there, but they're all different. It's like everyone at first was like, oh, the public markets, REITs are down, so prices are obviously down. No, it's a different asset class. There's different characteristics of it, but there is a signal there. But you need a structural relationship to understand what does a change in pricing in one asset class mean for another asset class. And that's an approach that is beyond the skill set. I mean, I'm not criticizing appraisers here. It's beyond the skill set of a lot of folks, but it's not something that gets into, a lot of training. And so this is something that we need better tools for folks to make sense of what's happening in other asset classes to bring it into our world. And, Ben here, I think, they're a little further ahead on this stuff than us. I think some of that is also just generational. You go back to the 70s and real estate here was more of a development kind of thing. Who cared about appraisals? I'm making money by taking a raw piece of land on the outskirts of Dallas and turning it into the productive economy. I'm making so much, who cares what the appraisal is? I'm making money hand over fist. As we become more of a yield-focused investment, as that pace of growth slows here, probably should be looking to be more like the yield-focused stuff that our friends over in the UK have had for a number of years.
Preston, anything to add to what Paula and Ben and Jim have been talking about so far?
Yeah, well, thank you, Geoffrey. You must have seen the wheels turning in my head. I guess a couple of things. One is I wonder what this conversation would be if we went back 2.5 years and when things were humming along. I don't know how they were in the UK, Ben, I apologize, but I know in this country, prices were sort of leapfrogging their way up. And transactions were happening at pretty big premiums to what the most recent appraisal was. And I'm not sure many people were whining or moaning or complaining about that or calling it a crisis. So, that kind of gets, it's rolling around in my head. The other reality is that a lot of people who are very close to the transaction world, i.e. the brokers, have been doing lots of brokers' opinions of value, both in good times, sort of 21, 22, as well as 23, 24. And, there's a pretty huge disparity. And those are the folks who are literally on the front line in the transaction world. So, there's something going on there. And I guess the other thing I would say is that in good times and bad times, when there are some transactions and there are people bidding, there's wide disparity. These are some of the smartest, most astute investors in the world that are bidding on properties, and there's disparity there. There's 2, 3, 5, 7% disparity. And so I guess I come back to the reality that this is an inefficient asset class, and that we, investors and others have to get a little comfortable with the fact that it's not the stock market where you're going to be able to pinpoint an exact value and say that's what it is. And frankly, look at the REIT market, the huge swings there, the volatility there. I wouldn't say that that's a perfect market either, and yet that's a public market, and you can get in and get out on a daily basis. So,
but it does raise an issue, Preston, as the problem with a lot of pension fund investors in particular is that they have to mark their portfolios to market to be able to know what their funding requirements are. And so it's a matter of funding cost to them as to where the valuations sit. So it's okay with them if they go up, and it's okay with them if it goes down. The problem is it reflecting what the market is? Is it a fair valuation? That's what people are ultimately trying to do.
100%. And unfortunately, there's got to be an acceptance of a little bit of tolerance.
Okay, now Paula, an anonymous attendee brought up this question. She said, Paula brings up a good point. Is the ACM in this regard not punting volatility? This would suggest that independence is being compromised. Do you think independence is being compromised?
I don't think so. Is that a question from someone in listening?
Yeah, somebody that didn't want to. He who must not be
I
named.
think our independence is being compromised. I will say that the battle for our independence is much harder because there are so many voices with a different opinion. And I think that's where the challenge is. I agree with Preston, whether you're in an up market or a down market, there's always going to be some range of reasonableness. And just because you might think market rent should be 50 cents different than the appraiser who's at, $40 and not $40.50, you got to be a little more realistic and realize that it's not one number.
Yeah, and I know, having been involved in the process myself, that there's a lot of dialogue that goes on between the managers and the owners and the appraisers. I've also
Geoffrey,
heard though,
can I just, I think all of us in the NFI Odyssey world have an appraisal management firm between us, the owners, and the actual appraisers. So I would say there's almost no dialogue between us, the owners, and the actual appraisers.
but you're
it's
talking to the appraisal managers, yes?
exactly.
Okay,
They're the independent sort of.
we
voice.
hear whispers. I don't know how true they are, and I don't know whether you hear them too, but from some folks that appraisers from time to time will complain about being threatened to lose the assignments if they don't come in with numbers that the owner or the manager feels they need to deliver to their investors. Have you guys heard anything like that? And what can we do about that?
I've heard stories about that, talking with appraisal clients who've told me stories. They won't tell me who, obviously, and it's confidential, but they've told me stories of trying to value assets, giving a report with a number, and then the manager dismissing them because they didn't like the number. It's not for cause, it's just because of they didn't like the number. And I've heard from some of the appraisal managers they've seen high amount of that in this cycle compared to the past. The way you get around it, you had regulations, that'd be one thing. We're not likely to get that. But I've one manager I visited with in Canada earlier this week highlighted how internally they disclose if they're firing a manager, they disclose that. Then rather, if they fire an appraiser, they disclose that. And they disclose the reason why, and they have a very good review process to be very transparent about that. I think that's kind of the issue. You need some transparency in the process to explain how you're doing this and how you're incorporating this information. And this notion of maybe treat it more like the audit process and do those kind of rotations so you don't have that institutional capture is an important thing.
Well, if we go back in time, 20 years ago, 30 years ago, there was even more angst in the marketplace about the credibility of the valuation process. I think we've made a lot of progress. We've come a long way. Maybe you guys could talk a little bit to some of the improvements that have been made in the appraisal process, and maybe talk to some of the things that could be done to lift it up a little bit higher and make it a little bit more credible moving forward.
Hey, Jeff, I'll start with that. A couple of things. I think in the UK, they actually have a valuation audit trail to track changes between the drafts that were delivered and the final reports. We don't necessarily do that here on the appraisal side. I think that's a great idea. I think it's more transparent. I think the other thing is, I believe in the UK, Ben, correct me if I'm wrong, you guys at RICS have quarterly meetings to talk about market changes, kind of just wrestling with, valuation issues. And we've talked about that at NACREIF, and we are going to implement a service provider or appraiser subcommittee on the valuation committee that will give the appraisers a platform and a voice to talk amongst themselves about market changes, where the market's headed, transactions, how you treat distressed sales. And I think that will even be better for us. I think that would be a good thing.
Yeah. I mean, we do have those, we call them sector calls. Obviously, you've got to be very careful about competition law rules, etc. So there's always that present. But that's one of the roles that the RICS can play as a valuation professional organisation, in that we control those issues. And if people do start to disclose too much, then we've got a set of words which we use to stop those transgressions. But that whole process. Now, I mean, I always look at evaluation, it's a process, but it's like telling a story. And you have to begin at the beginning and work through. You need to know what the instructions are. What is it that the client wants? What's the purpose of the valuation? What's it going to be used for? And one of the things that the international valuation standards and the RICS Red Book does is set out those initial instructions more than the use PAP. side does. That's one of the big differences. The USPAP doesn't require that detailed understanding of what the instructions are before you start. And so for example, the red book is pretty straightforward in that you get your instructions, you agree the purpose of the valuation, you agree what basis of value is going to be used. So is it market value or is it an investment value? What is it going to be used for? You then go to the market and collect your data. You then apply that data to your model. The model gives you a result, and then you write your report. And there shouldn't be anything in the report which is not in your letter of instruction. And so it creates, so really showing my age now, back to the 1970s of the virtuous circle, that it creates a quality assurance process which runs around. And it should tell that story from beginning to end, and there shouldn't be any missing chapters. So, the criticism we do see occasionally is, well, yeah, you say this in your report, you've got these numbers, but your results down here, and they don't, as you said, triangulate, Paula. They're not
Right.
They're not consistent. An evaluation should run through that story process and be able to be understood by another valuer. Valuers are going to make some judgment calls as they go through the valuation process. That's their job. But we shouldn't be arguing about whether one is $10,000 and the other's $20,000 or $1 million or whatever the right number is. We should be arguing about whether I've applied 5% and you've applied 6% and why that was. And that's the detail that we need to get down to in the valuation process. And that relies on good reporting, good file systems, because some of these questions won't get asked till some considerable time after you've done the valuation.
I want to continue along these lines, but I have a question that's kind of sidetracked a little bit from Meg Caposouzas. She says, for Ben Eider, is there a need for experienced commercial appraisers abroad? If so, where? It's my experience in the US that commercial appraisers are highly sought after.
That's a really $1 million question, that is, literally. It depends. The world's a big place. For example, in the UK, the valuation profession is aging rapidly. We are all, at least in our late 50s, or majority in the late 50s, early 60s, and you can see the sort of the line, the numbers coming in aren't the same as people finishing their careers. So there's an opportunity in that space. But you then go out to India and where the markets are really hot in different parts, and you suddenly find that actually all the valuers are 25, 30-year-old, really entrepreneurial individuals who are working through processing. So it depends in where you are in the world. You've got to understand the market that you go into. So it's really that process, but there's some great opportunities globally. We are going to be challenged by technology and how that impacts the valuation profession, AI or whatever technology you want to put. So our jobs are going to change, but good valuers who can make those real judgment calls are in demand wherever you are in the globe.
Yeah, we've got a lot of questions, so I'm going to start feeding those to you guys. Bradley Wood asked, to Paula's point, does the data identify who the preparers of these valuations are coming from, between internal AMC directed or direct to third-party appraisers, and percentage among those three?
So I'm not sure I understand the question. Is it the data that's coming from? Is that the question?
She's asking, does the data, I guess the appraisal documents, identify who the preparers of these valuations are coming from in terms of between internal, AMC directed, or third party?
Yes, in our review process, we usually will know where those comments and review are coming from. So we'll know whether we're dealing with the AMC or investment manager questions.
Okay.
But the point on that, for like all the return indexes that investors look at to make decisions on, where is it ultimately coming from for those managers? I know our team for our indexes, they started collecting some of that information on the raw data as it comes in, and there's been some analysis looking at do you have a different pace of write down between those groups. I don't know what the results were, but I know we were looking at collecting that because that's another point of information. Is there a difference between folks who have the same person helping them all the time versus someone where there's a rotation and they're just going to an individual? That's something I think we need to study over time. The market needs to know the performance difference just based on, who's doing the work for you.
So transparency on that would really help.
Yep. Now, Cindy Thomas asked, over the past 18 plus months, I've experienced and discussed with others that managers were more often arguing for lower values than the appraisers were providing, which is indeed a strange place to be and where I think the disconnect was. Anybody want to comment or respond to that?
I think a good manager is not always arguing for a higher value. And to me, when they do step up and say, hey, look at Inland Empire, look at it, it's really rapidly changed and not for the better, and you might want to relook at your valuation again. I really respect an investment manager who can call that and just, they're not always pushing values to be higher, but they're also looking from a lens of, is it reasonable in the current market? And they'll step up and say something if they feel like maybe you've missed a point. And I always appreciate that because usually they're going to see something turning in the market because they're very close to their acquisitions team and they're getting really good real-time data.
And Preston, you're managing a portfolio. Have you written assets up and down during this period of time?
Oh, absolutely. And the good news is it feels like most of it's behind us, but it's gotten closer and closer in terms of the numbers of up and down. Obviously, 4 quarters ago, there were many more assets being written down than being written up. And in this most recent quarter, it was about even. And it's because we have assets like virtually all the Odyssey managers. We've got assets in nooks and crannies all over the country. So it's very property and market specific.
Okay. And Sarah Rutledge has a question for Jim. How does the U.S. miss on appraisals in 2023 compared to the historical trend? Was it an outlier year, or is it pretty representative of what we've experienced in the past?
She asked that question. I should have thought to look at it ahead of time. I was only focused on that near-term challenge. I haven't looked at the full history on that yet.
What's your sense of things if you were going to be just taking a wild ass stab at it?
Oh, my sense of things is that this is a structural issue that we've seen before. I mean, go back to the financial crisis. I was at the CBRE Economic Advisor Center. I was working with some of my team members in London, and they were kind of snickering at the figures that were putting out for the U.S. on prices and cap rates. As London was tanking, it took a full year, even though New York was going through the same economic difficulties. You had 2 big financial hubs in the middle of a financial crisis. It took a full year before our assets in New York were actually being valued at something reflecting that down cycle. And it took a full year for cap rates in New York to kind of respond to the same kind of devastation that was going on in London at that time. So it's something that has been there for some time. Now,
Geoffrey,
I didn't look at the upside though. That's nobody cares about the upside risk. It is a risk because if risk is uncertainty around future outcomes, and so I should probably look at that too.
Okay.
right.
Preston,
Geoffrey, you probably remember in the early 90s, there were 2 firms which will remain nameless, but 2 firms that almost went out of business because their credibility was so shot around this entire appraisal issue.
I would say more than 2, but yes, there were a number. Yeah.
All right, we'll compare notes.
Yep. I got a long question from Scott Podvin, so bear with me as I try to go through it and try to follow along. We were trying to value a few apartment buildings in Gainesville, Florida. One such project, Noble at Newbury, had 2 identical mid-rise buildings, but obtained a construction loan for only one of the buildings and used its own credit line for the second building. The county only used the one construction loan to estimate the $56 million value upon which it charged document stamps, etc. However, CoStar reported the use of the $37 million credit facility. Now the value of the community is in dispute. Likewise, another project sold the multifamily apartments together with the surplus development rights, but those rights were not picked up on by the county. Thus, there is a $10 million delta between what was recorded in the public records and what the buyers received. How do we reconcile these types of deals?
Devil's in the details, and right now, and really any market, like as Preston said, you still have to dig into the details on the property, and it's very market and property specific. And that sounds like that was an issue there.
I think that jumps into the sort of comparable evidence issues as well that we really need to understand. When I used to lecture, I used to say that being a valuer was a bit like being Sherlock Holmes. You had to go out into the market, you had to find evidence, but you had to find evidence that may have to stand up in court, and you have to document it appropriately, and recognizing that the value of a building is not in the bricks and mortar concrete glass, it's actually in the contracts which drive the value. So, which detail the income and the expenditure, and that's what people are buying, not bricks and mortar. And there are still some valuers who still don't get that fundamental process.
I think it also points to, how do you deal with it? You hire a friggin' appraiser. You hire a person who can make educated judgments about the issues. Now, I'm not bashing CoStar. Yeah, they're a competitor of mine, but you can't argue with success. And Andy's built something fantastic. That revenue stream is amazing. But, and I should be the guy arguing that, because we're sending a bunch of data too. I should be the guy arguing, let AI value everything, get rid of the human, just let the machines come up with something. Our data in the commercial real estate world, despite, I've been trying to improve what we're collecting and how accessible it is since 1994, it is still so dirty compared to every other financial instrument in developed markets. Like the fixed income team here, talking to them, and when I described the RCA database when they bought us, they started snickering. It's a cute little database. They got pricing data by the picosecond in the public markets. I mean, it's just amazing how much more information there is.
Well, I think,
in our world, we don't have that. And so you can't, the AI tools eventually will help. You'll have some AVM stuff that helps at the margins, but I still think you still need that human judgment, because there's still so much variation in the cleanliness and the record keeping the data. We've been trying our best to get that all cleaned up, and it's improving, every decade compared to where we were, but there's still a lot of opaque nature. The market still has a very opaque nature. And so you still need that, credible human judgment to come in, just make sense of it all.
Yeah, Ben had a really good point about Sherlock Holmes. I mean, the analysis of a sale is still so important. And in the last 24 months where we've had liquidity issues, favorable seller financing has been so important. And I can't tell you how many times I've had to remind someone that, hey, there's value in that, and that's part of that purchase price that was paid.
Now, I think it's also, we have to be fair to ourselves a little bit. We're talking about the difficulty of valuing private market assets, not just real estate. I mean, infrastructure is difficult, private equity is difficult. I mean, there's lots of different asset classes that don't have good data. And we don't have great data, but we have a lot better data than we had 20 years ago. And my guess is it continues to improve. So this is all about improving the process, not about, trashing ourselves, trashing our industry, or trashing any part of it. Rami Yonkin has a question. Available data is much better and robust in large market areas, but less so elsewhere. How do you reconcile that gap between the quantity and quality of data, especially dirty data, we just talked about, between large markets and smaller markets?
You want me to take that, or
either you or Jim or Ben or Preston, whoever has something to say about that.
I'll jump in.
Go ahead.
Oh, okay, I'll start. So what we would do, I think in this market, it's been really tough because the secondary markets haven't seen as many transactions. I mean, we all know that even major markets, haven't seen a whole lot of transactions, especially early on. What we would do is, broaden your search. You just have to keep keep going out a little bit further to try to find something that's comparable, and then going back to the triangulation, making some, adjustments maybe in market rent and some other factors on the properties. I mean, you're never going to have perfect data, but the analysis of that data is just so important. Jim, I don't know how you guys look at it from a data standpoint.
Well, it's tricky. I think what you described there is how people should think about these things. Like, if, let's say, you're trying to value like a triple net retail asset in suburban Kansas City, and just given the accessibility of capital and the type of urban infrastructure and tax structures, maybe a triple net retail in other urban areas in St. Louis or nearby states would be comparable, because it's just the kind of capital looking at that. Does the process always allow that kind of stuff? Maybe not. And so that's something people should be thinking about, how they incorporate it for these less liquid areas. But there's more liquidity if you think about it from a broader perspective from geography. So I like your comment there, Paula. But then it's tricky too, because those big markets, some of them, like New York, is one of the most informationally efficient markets worldwide, because thanks in part to what Mayor Bloomberg set up to make the records more open. There's a reason a lot of real estate information companies got going here in New York. They thought they could just leverage that data and do the same thing worldwide, but it didn't quite work. But not every city's like that. You go to Texas and it's non-disclosure state, so you have to weed through run through the weeds more to get stuff, and a lot of talking to this and talking to everybody to figure things out, and so it just becomes harder to do that. Again, it speaks to the need of having educated professionals who really know the ins and outs of the markets and know who they can talk to get the real scoop, because it's still an opaque market.
Okay, well, Spencer Robinson has a question. Theoretically, value should represent the arm's length value between a willing buyer and a willing seller. To what extent might the sales in the U.S. have been distressed sales, not necessarily representing true value?
I think that's a great question. Preston, I think you and I also had kind of had a conversation around that. I'm a big believer in it. You have to still have a willing buyer, willing seller. I think some people that rejected the notion that you can't use a distressed, sale that's in LA or San Francisco on office because they're distressed markets. I think you have to step back and look at the bigger picture, and maybe the entire market is distressed and those are reasonable sales to use. I think there's some cases where maybe they're not because they're extenuating circumstances. But Preston, I know you have an opinion on that.
Yeah, no, I agree entirely, Paul. And it depends on who the seller is. The seller might be not a private owner, maybe the bank that happens to have come into ownership of the asset, and they just want to get it off their books. So there's obviously some interesting details that have to play into the analysis of that.
And the last part of that sentence is that they've both sides acted prudently and without compulsion, knowledgeably, prudently, and without compulsion, which are really important parts.
Thank you, Ben.
And really, what that's saying is that price is not necessarily the same as value. And we all know that, but again, it's really important that price is identified for what it is. But a valuation, again, market value, you need more than one person who would transact at that number. So again, sometimes it's best to look at the second bid to see how far that process is off the market. So taking the top one might be misleading. So again, it's really that interrogation of the information which is pertinent to that particular asset.
Yeah, and being compelled to sell is definitely impacting prices, not values. I'm not going to talk about, I don't have distress on that, but one of the folks who works with me, this young woman, Alexis, I posed a question to her. We have our CPPI, we look at repeat sales on deals. Can you put together a chart that highlights sell prices for the assets where they weren't compelled to sell versus the ones where they were? And yeah, guess what? In this downturn, there's a clear bifurcation of the compelled sales in the CPPI are definitely the ones on the low end of the distribution in terms of growth rates. So it's certainly having an impact on pricing, but I don't see I don't see the individual appraisals, so I don't know how many of them are going through into the indexes.
Well, you guys have done a great job digging into some of the issues. You know, I've never hosted a webinar where we answered 14 questions from the audience and still had 19 open unanswered questions coming in. So not only do I want to thank you guys for doing a great job, but also thank the audience for marvelous participation and engagement. I want to give John a few minutes to close up, but before I do, I'd like to give each of you the chance to make one final statement, something for the audience to take away and think about in regards to this whole issue of valuation improving the process. Paula, why don't you go first?
So I think that the industry as a whole, not just appraisers, but all the stakeholders in the process need better transparency and standardization, and governance. And the appraiser independence is so important that we all need to protect that. That's where I'd say.
Okay. Ben, you want to go next?
Yeah, I'd say we need to recognize how important valuation is to everything that happens. There are so many valuations that take everything you touch or see or come into contact has numerous valuations through the process, and we've got a really important role to play in society and delivering the best process that we can. And really lucky to have been in this profession and been seen what's happening globally. So yeah, be proud about being a valuer.
Great. Jim?
Yeah, being proud to be a valuer, that's interesting. I think it's an exciting time, actually, because we have all kinds of new tools that are becoming available. It's still an opaque market, but there's still some more data coming through. I don't think that's been fully digested and bringing in new techniques. I think there's a lot of work that can be done to make the market more transparent, to help people get there. Again, though, it's not just a database and clicking, it's all automated and you get the people out. I think you still need that human touch to make sense of it all. But it's I think an exciting time. When I do lectures at universities, I tell these grad students that I'm kind of jealous of where they are in their careers so far.
Okay. And Preston, one of the people wrote in, bravo, Preston, it is an inefficient market. You get the last word. Go ahead.
Yeah, and I think I really appreciate Paul and Ben's really thoughtful comments. I'm going to go back to a question that you had earlier, Geoffrey, and that is, are we aware of threats to appraisers? And I am not aware of that, but I find it abhorrent, but I'm not surprised. And that leads me to my I guess my suggestion. And my suggestion is I wish the consultant community, and it's those folks that sit between the money, the investors, and the managers, I wish they would get more active, and I wish they'd get tougher on the managers about some of these issues.
Okay, great. Thank you all. Did a marvelous job. Thank you, audience, for being so engaging. And John, the floor is yours. Oh, you're muted there, John.
Still muted.
There we go. Sorry about that. I thought Larissa was handling it. Thank you, Jeff, Paula, Jim, Ben, and Preston. I think you've answered many questions of institutional investors vis-a-vis the uncertainty around asset valuation, appraisal models, and the regulatory environment. As inveterate problem solvers, counselors of real estate are prepared and equipped to help their clients and employers capture opportunities and devise solutions to complex real estate problems. I would encourage you to consider engaging a designated counselor of real estate to help you enhance the clarity of your crystal ball, and when seasoned advice or a solution to a complex real estate matter is needed. Perhaps you might consider becoming one of us and seek an invitation to membership and the CRE designation for yourself. Please join us on April the 2nd for a special webinar featuring distinguished members of our Asia Pacific chapter discussing the dynamic East Asian real estate market. You may register at CRE.org. Until then, on behalf of the counselors of real estate, thank you for attending this session of What's Next for Real Estate and the Life Experiencing. Have a nice day.
Thanks,
Bye, everybody.
everyone.